All right, let's jump right in. Whenever we get into a deep technical discussion on IND AS, it's always the heavy hitters like IND AS 109 on financial instruments or 115 on revenue that seem to get all the airtime. But think about it. The ultimate integrity of everything we do hinges on how it's all presented in the end. And that is the exclusive domain of IND AS 1. This isn't just a formatting guide, not at all. It's the absolute foundational blueprint that dictates the entire structure and the core principles for all financial statements. It's what ensures the final output is coherent and, most importantly, actually useful for making decisions. And this quote, pulled directly from the standard itself, is the why behind everything else. This is the whole point: comparability. It's about being able to compare an entity against itself over time and against its peers in the industry. Every single rule we're about to discuss, every classification, every disclosure, every minimum line item, is there to serve this one single objective. As we go through this, just keep this in the back of your mind as the ultimate test for any presentation choice. So here's our plan. We'll start with a foundational scope and objective. Then we'll get very precise about what makes up a complete set of financials, citing paragraph 10 directly. From there, we'll get into the core principles like offsetting and classification. After that, we'll dive into the really high-risk areas, the estimation uncertainties and judgments that always attract auditor scrutiny. And finally, we'll connect all these principles back to the real world of statutory filing with Division 2 of Schedule 3. Okay, Section 1. Before we get into the nuts and bolts, we have to establish the standard's purpose and its jurisdiction. What exactly is its objective and which entities and statements does it actually cover? Now, this is an absolutely crucial distinction to make right up front. IND AS 1 is a presentation standard. It is not a recognition or measurement standard. It doesn't tell you how to calculate the value of PPE or a financial liability. That's the job of standards like IND AS 16 or IND AS 109. IND AS 1's job is to say, okay, once you have those numbers, here's how you must present them. It dictates the structure, the minimum line items, and the classification rules to make sure the end product is consistent, clear, and, that word again, comparable. So let's move on and define what actually constitutes a complete, compliant set of financial statements under this standard. IND AS 1 is very explicit here. These are the non-negotiables. There's really no room for interpretation. Paragraph 10 of IND AS 1 leaves no room for doubt. A complete set of financials includes these 5 specific components: the balance sheet, the P&L, the statement of changes in equity, the cash flow statement, and, of course, the notes. The key thing to remember is that these form an indivisible package. You need all 5 for a presentation to be considered compliant. You can't just pick and choose. Now, this might seem basic, but paragraph 51 lays out a critical compliance checkpoint: clear identification. Every single one of those 5 components must clearly and prominently display these details: the entity's name, whether they are standalone or consolidated, the reporting date or period, the presentation currency, and the level of rounding used. It sounds like simple housekeeping, but its purpose is to completely eliminate any ambiguity for the user right from the get-go. All right, so we've defined what the financial statements are. Now, let's dig into the core principles that govern how we present information within those statements. These are really the unbreakable rules of the road for financial presentation. The split between current and non-current is an absolute cornerstone of IND AS 1. And while we all understand the basic principle, the real complexity emerges in specific, high-judgment scenarios. For instance, think about a loan liability where the entity has breached a covenant at the reporting date. This is a classic area of focus. Even if a waiver is obtained from the bank after the balance sheet date, IND AS 1 is strict. The classification must be based on the conditions that existed at the end of the reporting period. This comes up all the time in audits and is a frequent cause of potential restatements. Here's another fundamental rule: the general prohibition on offsetting. The default position always is gross presentation. Why? To provide full transparency into the true scale of an entity's finances and operations. However, and this is critical, you have to be aware of the specific exceptions that are actually mandated by other standards. For example, IND AS 109 requires offsetting financial instruments under very specific criteria. IND AS 12 does the same for deferred tax assets and liabilities. Knowing when to apply those specific permitted exceptions is absolutely key to getting it right. Okay, let's shift gears now into what I consider the most subjective and high risk parts of the standard. This is where financial reporting stops being just about applying rules and starts involving significant management judgment. And as you know, wherever there's judgment, that's where auditor scrutiny is going to be the most intense. So, where should we, as preparers and auditors, be applying the highest degree of professional skepticism when we're working with IND AS 1? Well, the standard itself actually points us directly to the key pressure points. The number one area is, without a doubt, estimation uncertainty. IND AS 1 is very clear that management must identify and disclose the key assumptions about the future that carry a significant risk of a material adjustment to asset and liability values within the next year. We're talking about things like goodwill impairment testing, the valuation of Level 3 financial instruments, or estimating complex provisions for litigation. The whole idea behind this rule is to force these critical judgments out into the open for everyone to see and scrutinize. And it doesn't just stop at identifying the uncertainties. The disclosures have to be robust. You have to explain the nature of the assumption, the sensitivity of the carrying amounts to changes in those assumptions, and even provide a range of reasonably possible outcomes. So the takeaway here is crucial. It's not just about the final number you booked. It's about disclosing the judgment, the estimates, and the potential volatility behind that number. That's what gives users a true picture of the underlying risks. All right, for our final section, let's bring this all home and connect these principles to the statutory filing reality we face here in India. How does IND IS 1 actually integrate with the format laid out in Division 2 of Schedule 3 to the Companies Act? This is such a critical point to be clear on. Schedule 3, specifically Division 2 for us IND AS companies, is not a separate set of accounting rules. It is the mandatory format. The underlying logic, the brain behind the operation, what defines an asset, the rules for current versus non-current, all the presentation principles we've discussed, that all comes directly from IND AS 1. And this table really illustrates that direct link perfectly. The balance sheet required by IND AS 1, it's presented in the format of Part 1 of Schedule 3. The statement of profit and loss, that slots right into Part 2. And the statement of changes in equity and the notes have their own dedicated sections. It's a clean one-to-one mapping. It shows you exactly how the principles of the standards translate directly into that final, compliant statutory document. So, as we wrap this up, I want to leave you with one final thought. IND AS 1 gives us the rules for compliance, but its real objective, remember, is comparability and understanding. So the question we all have to ask ourselves, as preparers and auditors, is this. Are our financial statements just a technical exercise in ticking boxes? Or are we genuinely using this framework to tell a clear, transparent, and useful story about the entity's real performance and position? That's the difference between simple compliance and truly effective communication.